All right, Travis, tell us about what makes up all the parts to a house payment.
Okay, so yeah, it's not just as simple as your rent, right? You pay $1,200 a month in rent. You just write that check for $1,200. Mm-hmm. Well, a mortgage is a little bit different. There is usually up to really 4 parts to your payment. Actually 5. You've got your principal and interest, right?
Okay.
So that's your standard.
That's the house itself and the interest on the loan.
Right. That's your loan payment.
Yes.
In most cases, especially with first-time buyers, you'll roll in your taxes and your insurance in your payment. That's called escrowing here. And so you have your principal, your interest, and then your taxes and your insurance. How that's factored is you take 1/12 of your homeowner's insurance premium, your annual premium, and 1/12 of your annual taxes, and as part of your monthly payment. So every month you're making that payment for those bills, and then your lender is holding that 1/12 of the taxes and insurance in what's called an escrow account. And then when those bills come due, your lender will cut those checks for you. So you don't have to worry about it. It's all built into your payment. The 5th part is your PMI, or private mortgage insurance. That will happen if you put down less than 20% on a conventional loan. It will be always on your payment if you do an FHA loan, regardless of how much equity you have. And USDA as well. There's a little bit of PMI in your USDA payment. VA does not have PMI, even though it's 100% finance. It's great. What they have is called a guarantee fee, so they collect it all up front instead of monthly. And so the 5 parts of the payment, again: principal, interest, taxes, insurance, PMI. Now what the PMI does is it protects the lender against you defaulting because you put down less than 20%.
Right.
And on a conventional loan, the PMI can actually be dropped off of your payment once you get to 20% equity.
Does that happen automatically or no?
It does on a certain amount of time. So it's listed out in your loan paperwork that regardless, it will be dropped off at a certain amount of time. However, I have seen that if you have appreciation or you pay down your loan
faster,
yeah, then you can call your lender, whoever's handling your payments, and talk about getting the PMI removed.
Yeah.
And they have a process for that. But again, with FHA, regardless of how much equity you have, regardless of how much you put down, you'll always have PMI in your payment.
So not for you to recommend everyone, but me. I'm telling you that I don't want to pay that PMI the whole time I'm paying the FHA loan. Do you recommend refinancing soon?
Yeah, once you get to the 20% equity, you'd refinance into a conventional for sure. And actually, what's really cool, conventional has this other option too, where you can do upfront. You can pay your PMI at closing. We do that a lot. So for example, let's say somebody is looking at a home and they want to put down 10% on a conventional loan. That still has monthly PMI, right? Because it's less than 20. But what we'll look at is we'll say, you know what, why don't you put down 5% and pay your PMI at closing in one lump sum. And what happens is, and there's no monthly PMI at that point, right? Because they paid it all at closing.
Yeah.
Their cash to close is less than the 10% down, and their monthly payment is less than the 10% down with PMI.
Yeah.
So they're keeping more money in the bank, and their monthly payment's lower. It's a win-win. It's a great strategy to look at. But conventional does have that flexibility with PMI.
Yeah. Cool. All right. Thanks, Travis.
Thank you for joining us for the last video in the financial side of buying a home video series. I hope this series was informative for you. If you have any questions on any of the topics covered, please comment below and I'll get them answered. Thanks for watching.